Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we are doing a deep dive into something that sounds pretty niche on the surface, but it's secretly pulling the strings behind some of Asia's biggest economies.
And that's the Taiwanese dollar, the TWD.
Exactly. It almost never makes global headlines, but we're going to argue that its exchange rate is maybe the single most important factor for the financial health of manufacturers across the entire region.
It's a total invisible force.
Mm.
The analysis we're looking at calls it an invisible benchmark, and that's really the perfect term for it, especially for places like South Korea and China.
So for anyone listening who's tracking, global supply chains, tech stocks, or just trying to get a read on Asia in 2026, you really have to understand this one currency.
It's absolutely essential.
Our mission today is to crack that code. We need to explain why the TWD is treated less like a normal currency and more like, well, a tool of industrial policy.
A geopolitical tool, even.
Yes. We're going to get into its unique managed status, and this is the key part, look at the constraints it puts on its major competitors, specifically the Korean won and the Chinese yuan.
All right, let's jump in. The whole thing is built on a paradox, really. It just defies basic economics.
Okay, so let's tackle that head on. The TWD's official status. On paper, it's supposed to be a free-floating currency, right? Meaning the market sets its value.
That's the official line, yes.
Right.
But the data makes it very clear that it's operating under what's called a managed float system. And managed is doing a lot of heavy lifting in that phrase.
A managed float. Okay, for listeners who might be new to this, let's use an analogy. The car analogy.
Right, the car. So a truly free-floating currency, like the US dollar for the most part, is like a car where there's global supply and demand is pressing the accelerator.
If people are optimistic, they buy dollars, the car speeds up, the value rises.
Exactly. But with a managed float, you've got Taiwan's central bank in the passenger seat, and their foot is always hovering right over the second brake pedal.
They have a speed limiter.
A very strong, always-on speed limiter. The market can push the gas, sure, but the central bank makes sure the car never goes too fast. They prevent it from appreciating too quickly.
And how do they physically do that? How do they hit the brakes?
Well, think about it. When a company like Apple needs to pay TSMC for a huge order of chips, they need TWD, so they go to the central bank with US dollars.
That creates huge demand for TWD, which should push the price up.
It should. But to stop that, the central bank basically prints new TWD to meet that demand, and then it takes the US dollars it just got and sells them back into the market.
So they're artificially increasing the supply of their own currency to keep the price down. It's like a store constantly restocking a popular item so the price never goes up.
That's a perfect way to put it. They absorb all that incoming foreign cash and stop it from strengthening their currency. Now, their official reason is always about creating an orderly market, preventing volatility.
But everyone knows what's really going on.
The market observers all agree. The consistent goal, the structural outcome, is a weak currency to protect export competitiveness.
And this is where we get to the paradox. Because this policy runs completely counter to their actual economic strength, Taiwan has one of the world's biggest trade surpluses, right? Sometimes over 30% of GDP.
That 30% figure is just massive. To put that in perspective, it means for every $100 of stuff they buy from the world, they're selling $130 worth of their own stuff back.
So in a normal textbook economy, what is supposed to happen?
Appreciation. A huge appreciation. All that global demand for their goods means huge global demand for their currency. The price should, by all rights, shoot up.
But it doesn't. And that's the anomaly, so why do it? Wouldn't a stronger currency mean Taiwanese people could buy cheaper imports?
It would. And that's where this whole thing stops being about pure economics and starts being about strategic national policy.
Because of their unique geopolitical situation.
Exactly. Because of Taiwan's limited official recognition internationally, its economic power, driven by those exports, is its primary leverage on the world stage. Economic survival is national security.
So keeping companies like TSMC and Foxconn globally competitive with a cheap currency is more important than giving consumers cheaper iPhones.
That's the calculation they make, yes. The exchange rate isn't just a number on a screen. It's a weapon in the global manufacturing war.
Okay, so if Taiwan is using its currency as a weapon, let's talk about the collateral damage. What are the ripple effects across Asia?
The ripple effects are profound. The TWD basically becomes the implicit benchmark for the whole region
Because of their position in the supply chain.
because they're at the absolute core of it. We're talking semiconductors, electronics, IT hardware. They set the price on components that go into everything. That gives their currency an influence way beyond their borders.
So let's look at the most direct competitor, South Korea. The Korean one, the KRW.
Right? South Korea and Taiwan they are fierce rivals, direct competitors. Think semiconductors. You have TSMC in Taiwan, and you have Samsung and SK Hynix in Korea. They're constantly fighting for market share.
So walk me through it. If Taiwan's central bank is purposefully keeping the TWD weak, what does that do to a company like Samsung?
It puts them in a bind
Yeah.
immediately. Imagine a big U.S. company is looking to buy $1 billion worth of memory chips.
Yeah.
If the Taiwanese supplier can offer a lower price in U.S. dollars simply because their currency is artificially weak,
The Korean supplier has to match that price or lose the deal.
and if the Korean won is stronger, matching that price means slashing their own profit margins. It's just unsustainable.
So TWD weakness acts as a ceiling on KRW strength.
A structural ceiling, absolutely. The Bank of Korea can't just let the won appreciate freely, because if it gets too strong relative to the TWD, their entire export sector becomes uncompetitive overnight. They're forced to play defense.
It's like they're anchored to the TWD. But what about China, the yuan, the CNY? How does this affect them? It's a much bigger economy.
It's a more indirect effect, but it's just as powerful. China, of course, also wants to manage its currency for export stability. What a weak TWD does is it makes the Chinese yuan look strong in comparison.
Even if the yuan isn't actually moving much.
Precisely. It's all relative. If your direct competitor in high-end electronics is actively devaluing, it makes it politically and economically very difficult for the People's Bank of China to allow the yuan to strengthen significantly.
It would be like giving their competition a free gift.
You've got it. It gives the PBOC a sort of cover to resist pressure, say from the U.S., to let their currency rise. They can point to the region and say, look, we can't afford to lose competitiveness against hubs like Taiwan.
So the TWD acts like a downside pressure buffer for the yuan.
A perfect description. And this effect cascades. It goes beyond Korea and China. It pressures currencies in Southeast Asia too. Thailand, Malaysia, Vietnam. They're all part of the same electronic supply chain.
If the king of high-tech components is keeping its currency cheap, everyone else down the line has to follow suit.
They have to. It creates this region-wide pattern of managed weakness, all centered on this one, quiet currency. It completely changes how you have to look at Asian FX markets.
Let's bring this into today then, early 2026. What are the factors right now that are reinforcing the strategy for Taiwan? The first one seems to be what's happening with the US dollar.
Right. So the U.S. Fed is signaling a move towards an easing policy, which usually means a weaker dollar. Now, in theory, that should let Asian currencies strengthen.
But that's not what the data suggests will happen.
Not for Taiwan. For them, a weaker dollar just shifts the game. It stops being about TWD versus the dollar, and it becomes all about TWD versus the Korean won and the Chinese yuan. It becomes about relative competitiveness.
They just double down on managing the exchange rate to make sure they don't lose their edge against their neighbors.
Exactly. The second big factor is the ongoing U.S.-China tech competition. This has really solidified Taiwan's strategic importance, hasn't it?
It's made them indispensable in semiconductors.
Absolutely. And because of that, the government there now views the exchange rate as a matter of national security. A competitive currency means profitable exporters, which means more money to pour into R&D and stay ahead in the chip race.
So letting the currency get strong would actually undermine their national security strategy.
It's politically unacceptable for them. And the third factor is the semiconductor cycle itself. It's recovering, demand is up.
Which means a flood of foreign money into Taiwan to pay for chips. That should drive the TWD up.
It should. But the analysis suggests the opposite will happen. All that incoming foreign currency, all those U.S. dollars, just gives Taiwan's central bank more ammunition.
More firepower to intervene.
Exactly. Their reserves swell, which means they have an even greater capacity to sell those dollars and keep the TWD right where they want it.
So let's get down to the brass tacks for an investor listening to this. What is the key takeaway? How should you think about the TWD?
The main takeaway is this. Stop thinking of the TWD as a currency you can bet on to appreciate. It's not a profit opportunity. You should see it as the currency ceiling for the entire region.
It's the limit, a structural barrier.
Right. So if you're an investor and you see a forecast that the Korean won is going to surge 10% next year, there's a test question you have to ask yourself first.
Which is?
Will Taiwan tolerate that? Because a 10% stronger one puts Taiwanese exporters at a massive disadvantage. As long as Taiwan is managing its currency this way, it puts a hard cap on how much strength is possible for the KRW, the CNY, or any of their neighbors.
So the data suggests investors should just stop chasing currency gains in Asia.
I think so.
Yeah.
The smart play isn't betting on the currency. The managed system supports manufacturing profits, but it kills the upside for FX gains. It makes much more sense to focus on the relative performance of stocks and credit.
Find the best companies regardless of the currency.
Find the companies with the best technology, the strongest market share, the best cash flow. Their performance will shine through even if the currency itself stays flat. The profit is in the company, not the conversion rate.
So to sum all this up, the Taiwanese dollar might seem quiet, maybe even boring, but its management is the most important structural force in Asian currency markets. It's the invisible standard for the entire region.
And that brings us to the final question you should keep in your mind for 2026. It's not, will the US dollar get weaker? The real question is Taiwan willing to step back from using its currency as a competitive weapon?
And looking at all the signals, their policy, the tech war, their geopolitical reality, the evidence seems to suggest the probability of them backing down is extremely low.
Very low. It remains that powerful, invisible anchor. It keeps the waters calm for their exporters, but very, very choppy for anyone betting on currency appreciation.
Don't forget to subscribe and hit that like button.